Hey guys, today we're talking about diversified investments, the holy grail of reducing your volatility in your portfolio. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisor Group here at Canaccord Genuity Wealth Management, and I am pumped today to be talking to you about diversified investments. So if you like what you hear here today, please give us a like, give us a share, and more importantly, you have questions, go to www.speaktorob.com. We'd love to book a no obligation consultation for us to have a chat specifically about diversified investments or anything else on your mind. What does true diversification mean? True diversification, in my mind, first of all, is a movement in prices of your asset classes that are traditionally either uncorrelated or reversely correlated. So historically, back in the old days, what that meant was effectively three asset classes, three or maybe four asset classes. You had stocks, you had bonds, you had cash, sometimes people would call that as an asset class, and typically you'll have either gold or commodities as kind of another asset class. Now, in the old days, let's break it down to two asset classes, stocks or equities and bonds or fixed income. For the first kind of 80 years of the decade, of the century I should say, most of those asset classes moved in reverse order. So reversely correlated or inversely correlated. So you had a stock move positive, a bond move negative. So what that would do for you long-term in your portfolio, if your stocks were doing unreal and you had half of your portfolio in stocks, the other half in bonds, each of them paying an income stream, the dividends from the stocks, the fixed income coupon payment from the bonds, you kept collecting your income. In addition to that, they would move in reverse order. You were kind of more likely to have positive gains and less likely to have significant negative returns. What ended up happening over time is eventually that correlation rule kind of went out the window. Gone are the days where stocks and bonds are completely inversely correlated. So correlated means one movement, how does another asset class move with respect to that movement? So in a perfect world, you'd have a situation where stocks are positive, bonds are negative, bonds are positive, stocks are negative. That's not the case. So what we like to do, what we believe in doing with respect to diversifying your investments is actually having asset classes that are truly uncorrelated. And then in addition, inside of each asset class, you should have different either geographic or different sector allocation for that asset class. Let me give you an example. Let's start with a portfolio. Let's assume it's 50-50. It's got 50% stocks, 50% alternatives and fixed income. First of all, on the stock side, traditionally what we've seen here, so many people come to us with portfolios where they got nothing but Canadian stocks. This is the old rule back in the day where you had to have a certain percentage of your asset allocation in Canadian equities. Well, that's no longer the case. Canada is 1.6% of the global GDP, and yet we continue to see portfolios that have 80, 90% Canadian equities. There's nothing wrong with Canada. I love Canada. I'm a big Canadian homer, but let's diversify outside of one country. So specifically, the risks with Canada is we're extremely heavy financials and extremely heavy oil and gas. So those two sectors, if they do great, your portfolio will do great, but if they don't, your portfolio won't do great. So there are other countries, so first of all, countries. So you should have some US in your portfolio. You should have some global equities in your portfolio. You should have some, European, Asian, Australian. Those would make a lot of sense in your portfolio because now you're truly diversifying. Because if Canada's not doing well, perhaps Europe is doing well, or USA is doing well, or the global stocks are doing well, and vice versa. That is proper diversification. So inside of your stock portfolio, you could have geographical diversification. You could also have sector diversification. So certainly don't go load up on one sector inside of your own stock. So don't go loading up on 6 Canadian banks and nothing else. I mean, you will have an extremely undiversified portfolio because most of those stocks, they move in unison. So when one bank stock's up, usually they're all up and vice versa. So you want to have some manufacturing, some consumer staples, some consumer discretionary, some real estate, some infrastructure, some utilities, some telcos, some insurance companies, some financials. That's how you kind of diversify. Some tech, some healthcare, some growth versus some value. So that's so we talked about geographic, we talked about sector. I just talked real briefly about growth versus value. So you definitely want to have some growth names, the tech and the healthcare. And you also want to have some value. So you're trying to buy stocks at a discount to what you think they're actually worth based on a cash multiple. So that's generally the diversification on the stock side. Now, when we get to the bond side or the fixed income side, the diversification there, historically we saw a lot of portfolios that had just a ton of Canadian fixed income. So municipal, provincial, corporate bonds. Well, you want to diversify. First of all, if those are the only bonds you have, hopefully they're in more than one country. Again, you want to diversify your fixed income. You want to get some, triple Bs. You want to get some, perhaps some mortgages, some private debt. You want to take a look at adding some income notes to your portfolio that are principal protected. So on the guaranteed side of your investments, if you have any fixed income in your portfolio, take a look at diversifying outside of just traditional long Government of Canada or corporate bonds, because you want to optimize, you want to reduce that volatility, and you want to optimize your yield as well. Finally, the big way that I really like to diversify portfolios is to take a look at truly uncorrelated asset classes. For us, that means adding alternative asset classes. So that could include private real estate, it could include private equity, it could include private debt. So all of these are uncorrelated to the stock market because they generally do not trade on the stock market. So the stock market might go up 50 points or down 1,000 points or up 500 points. And these typically have an extremely stable, what's called a NAV or a price per share. So the price per share will not move generally as the market moves. That's extremely valuable in your portfolio because if there is a big crash, you keep your net asset value up and therefore your portfolio suffers way less downturn. So these alternative asset classes, in my view, are extremely important to properly diversify your portfolio, and most of you don't have any in your account. It's an extremely important asset class to try to add. Don't try to do this on your own. I strongly suggest you get someone to help, someone like us. Go to www.speaktorob.com. We'd be happy to help you out with that. What it does is you get way less volatility in your portfolio. You get your cash flow. A lot of these pay a stable, consistent cash flow so that if there is a correction, you're protected. And not only that, but the returns are uncorrelated. In 2018, for example, when the market was down in Canada and in the US, these asset classes performed positively. So again, folks, diversification, geographic, sector, growth versus value on the stock side, diversified in different types of fixed income and bonds on the fixed income side, and much more importantly, adding an asset class that is truly uncorrelated to the performance of traditional stock markets. That's how you do it, folks. Thanks for tuning in. I'm Rob Tatro from robtatro.com. If you liked what you saw, again, give us a like, give us a share. I'd love to hear your comments on diversification, and go to www.speaktorob.com. Thanks for tuning in, guys.